Welcome to Crypto in America Live, the only show bringing you candid conversations on the biggest news stories, legal issues, and policy developments shaping the crypto world every Friday afternoon. Happy Friday, guys.
Happy Friday.
Happy Friday. Happy almost Memorial Day weekend. Is it? I guess we could say that, right?
Yeah. No, I think we're officially there. I know a lot of people are getting off work at like noon, doing a half day today. So
Yeah,
we
so
can
you could
call it,
listen to this.
yeah, we can call it officially Memorial Day weekend. Yeah.
I'm
Yes.
always thrown off because I think Memorial Day weekend should always be the last weekend in May. So when it falls on the weekend before, maybe it always falls on the weekend before, but I always just think it
Yeah.
should be the last weekend. So when it's not, I get a little confused, but
Those
it's
pesky
Memorial Day weekend.
American holidays just moving around on you. Yeah.
Yeah,
Yeah.
yeah. Well, I'm
I'll
American
take
now,
it.
so I need to get up to
That
speed with my
is.
holidays.
You doing anything fun?
No, well, it's supposed to be really, I mean, it's nice out today. I'm looking out the
I
window and
know.
it's sunny, but it's gonna be really rainy, right?
Be
Everyone's talking
horrible.
about, like,
Yeah.
thunderstorms at the beach.
hmm
Yeah. No, I was talking to some people about this at dinner last night. It was like 95 and sunny in DC for the last like 3 weeks, and now it's 60 and raining. And
Yeah.
so yeah, literally raining on the parade. So that's okay.
Yeah. Are you guys going away?
I'm going to the
I'm hanging out.
beach, which is exactly what we're talking about here. So comical, but maybe it'll clear up for a little.
Yeah,
We'll see.
but not, like, away. You're not going on, like, tropical
No,
vacation.
no,
I
I
guess we're going to
wish.
Paris next week, so we need to rest up for that, right, Jacqueline?
Next week, yeah.
Yeah.
We'll be at Proof of Talk in Paris.
Yep.
So hit us up.
Good time. Yeah, yeah. Um, all right, well, let's get to our show today. We've had quite a newsy week for the space. I was almost expecting it to be a little quieter after the Clarity Act went through the Senate Banking Committee last week, but crypto never sleeps, so I shouldn't be that surprised. But we had President Trump signing 2 executive orders aimed at lowering barriers to entry for fintech and crypto firms into the financial system this week. We had the Fed taking another step towards implementing payment accounts to make it easier for those companies to clear and settle transactions. And we have some new clues into what the SEC's tokenization innovation exemption is going to look like. Maybe also has some clues into when we might be seeing that finally roll out. So let's start with that exemption because we set the scene a little bit here. Let's go back to Monday, and feels like a long time ago now, but Bloomberg dropped a piece that suggested the SEC's exemption was going to include something called synthetic shares, which is where the token, if you're going to tokenize a stock, the token tracks basically the price of the underlying stock, right? It doesn't actually represent any kind of on-chain ownership for the stock or the equity. And the person who owns it does not have any share, it doesn't have
Yeah,
any rights
redemption
to
rights.
shares,
Yeah.
dividends, right? So it's quite a different model than an on-chain equity ownership model. So I think people were quite surprised to see that. And there was a lot of debate on Twitter whether that should be allowed. We saw Brett Redfern over at Securitize come up with a statement saying basically this will fragment the market and create a whole different kind of market. That I think we pulled up his statement here, right? Is that up on the screen? Yeah. If third parties can tokenize Apple or Amazon without the issuer at the table, there's no theoretical limit on how many wrappers of the same company exist at once, which makes investors less certain that their shares are actually worth what their shares are actually worth at any moment. So there was this whole debate, which was interesting. Before I go any further, do you guys have any thoughts on that?
I mean, it's a big conversation on the front of like native token issuance versus like a wrapped version or one that doesn't even exist in the public markets. We actually have Robert Leshner backstage, the CEO and co-founder of Superstate. If we want to phone a friend and bring him in.
Yeah,
Yeah,
let's
let's
bring
do it.
in Robert because
Hey, Robert,
he's
how
an
are
expert
you?
on this. Yep.
Hey, everybody.
Yeah.
Good to see
Yeah,
you.
so your tokenized funds are structured so the tokens represent real on-chain ownership rather than synthetic exposure, right? So it feels like maybe the market and regulators too are starting to favor that real ownership model over synthetic exposure models. Does that create a problem now for companies whose businesses were built around wrappers and derivatives instead?
Well, I think it's a really interesting question. And, I think we should start at the SEC's taxonomy on what other different types of tokenized securities before we say one is preferred or not preferred, right? So they've really laid out a couple different buckets. The first are issuer sponsored tokens. That's where, that's just the superstate model. That's where an issuer, a public company, or a fund sponsor says, please tokenize my security, right? That's pretty vanilla. It's still in its infancy, and we haven't started to see those tokenized securities, interact with DeFi or trade heavily, right? The second camp of the token taxonomy are third-party sponsored securities. Now, this falls into two buckets, right? We have security entitlements. This is the model that the DTCC is pioneering. This is where an intermediary that's regulated and is expected to already create security entitlements is creating a tokenized security. So this can be the DTCC model. This can be the Robinhood model as broker-dealer. This is where, I think of it as participants already in the financial system creating a token, right? This is not yet synthetic. And then there's the synthetic securities bucket. And this word came up in, Commissioner Peirce's tweet last night. There's the synthetic one, which is sort of this third category, which is, there's varying degrees of quality here. I think there's some that can be extremely high quality, some that can be extremely low quality. But synthetic means, it's not created through a regulated intermediary in the US system to create a security entitlement. It's something that's backed by, a share somewhere, right? And, there's also things that aren't even tokenized securities. We have all sorts of like tracking derivatives and swaps and all these things that are out there entirely. And, I just want to start there, but I think it's too early to say that the SEC has favored one model, right? Because they've also favored this entitlement model. They've given no action letters to the DTCC. They've, greenlit, experimentation here. So I don't think they're favoring one model. I think they're actually still extremely open-minded. But I think as they're thinking about an innovation exemption, they're looking across all of this and saying, where do we start? Tailoring, an exemption to enable new activity that's right now stalled or has high frictions with, the existing regulatory structure.
Mm-hmm. And like, who would you say falls into the sort of the wrapper derivative category, Robert? Because I've been trying to figure it out sort of as I'm analyzing in my head. Like obviously Superstate kind of falls into the native on-chain equity model. We also have Securitized, who I think falls into that model as
That's right.
well. And then we have, you mentioned the Robinhoods. I spoke to Johan over at Robinhood when we were at Consensus, and they kind of have like a split model, I think, where some of their like EU stocks falls into the not synthetic, but the other one that you mentioned, where it's like
Intermediated, yeah.
broker dealer. Yeah, yeah. And then they also have the one where they are offering pre-IPO shares, which I think is more of along like the synthetic line. So it kind of like they kind of straddle that the divide, if you will. So can you kind of break down for us like which companies are offering these kind of like synthetic tokenized models, just so I can understand like kind of who and where and what?
So by far the most popular ones right now, are, and this goes to, the third-party tokens. And these are, it's a subsection of how the SEC defines this, but these are probably like linked securities. Products like Xstocks and Ondo and Denari. These are the popular, assets that are in the, synthetic bucket. Sometimes they're linked to an underlying security. It's bought in a brokerage account, put into an SPV or a trust or an offshore thing. And it's not a pure derivative. There's also synthetic things that are just pure derivatives. We've seen a lot of this, in like some of the more like perp market stuff where they're like, there is nothing backing it really. It's just, a price feed or, asset and liability between two parties, there's a whole spectrum here. And, but those are, I think, some of the more popular tokens that are synthetic.
Robert, what do you think on that last point about how this could impact like price discovery? Because like one of the things that I think we were talking about before you hopped on was like this potential fragmentation of the market. It seems like we deal with this on the like commodities derivative side all the time, right? Where it's like there's information going into the market, there's certain tools that people are using, whether it's like a binary future or something else. And it seems like now if we get these like synthetic shares, and even I've seen on prediction markets like sort of binary futures on just a price movement of a share, it seems like all of this may lead to more price discovery for some of these. And even when we start talking about like the secondary markets, that's always been super opaque. So it should be kind of interesting to see what happens with some of these pre-IPO companies. But like, what do you think this does for like the price in equity markets overall?
Yeah, so I think in general, right, from like a philosophical perspective, more information is better for everybody. We've started to see a lot of success with, markets that trade over the weekend informing how markets open up in the regulated, listed markets. Like a great example of this is like there's a lot of hedge funds that are literally watching lighter and hyperliquid at Sunday, like 5:30 p.m. before futures start trading in the US for like, equity indices. And they're literally saying, well, how is the crypto market, which they're somewhat rational players, how are they pricing things, when the normal regulated instruments aren't yet trading? Like 5:30 p.m., everyone has their like screens open. And it's like lighter and hyperliquid, and they're like pulling this stuff up. That's already happening like with real players on Wall Street, right? It's like more information is better, and it's actually like providing a signal, right? Is it the exact same asset? No, not really. There's some quirks and differences, but like it is good for everybody to have this information that's not already there. And so, I think there's advantages to having lots more instruments of all different qualities and like all different characteristics. I think there's downsides to it. Nobody wants there to be 49 different versions of Tesla, especially because at that point, nobody knows the difference between these things, right? Like
Yeah.
the most sophisticated like hedge funds on earth and like, market making firms, like they're in the business of knowing these minute differences between these things and figuring out how to trade them and arbitrage them and where the risks lie and all of that stuff. The average person does not and never will, right? They're just, they're only going to find the downside of this stuff. And so nobody wants 45 versions. And so I think that's like the trouble that, if you're a regulator, you're looking at, you're saying, well, this is net an opportunity. Like these are new technologies, these are new tools. There's huge benefits here for this to be more widely traded, more widely disseminated. It's good for capital markets, frankly. But there's also risk, which is like, do we want 45 Teslas?
Mhm. Of those 45 Teslas, for example, or any of these not native issuance tokens, do you think it all just will crash and burn one day then? Like, what is kind of the end result here?
Yeah, I mean, at the end of the day, like, most things get a network effect, right? Like liquidity has a network effect, and like certain things will scale and like become effective. Like I think we'll have like 45 versions of Tesla, but we'll have like 3 of them that have the most volume, the most
Okay.
interoperability, et cetera. Like I don't think we're, going to have 45 things that all have equal market share. I think we'll have
Yeah.
probably a
No.
couple things. But it's a really, really, really hard question. And if you're looking at this, from a seat in Congress or from the SEC, you have to ask that. What is the end state here? Is that a system we want? I think it's too soon to tell. I think the free market will decide in a lot of ways. They'll say like, hey, we like these 5 solutions. We don't like these 40. But I can't predict what that's going to look like.
Mhm. Robert, Eric Balchunas from Bloomberg had a tweet yesterday that said basically tokenization, he thinks, may ultimately now just become a new way for distribution of traditional securities rather than a reinvention of the markets. Is that how you ultimately see tokenization ending up?
No,
Or
not at
no?
all. I'm gonna take the hard disagree on this one.
Okay.
So the reason why I disagree is yes, it is a wonderful distribution channel, right? Right now, as of today, before there's an innovation exemption, before there's any rules that are written specifically for tokenized securities, before Section 505 of like the draft clarity, bill, gets signed into law. As of today, tokenization of securities, mostly on the synthetic side, pretty much all on the synthetic side, is just a new distribution channel. That is the value proposition that you would see if you just looked at the market today and you didn't look any further than that. Where we're going is this stuff is not just distribution, right? This is efficiency. Like it's efficiency for how securities settle and trade. This is the reason why NASDAQ, NYSE, DTCC, like the existing market structures looking at tokenization, they're not going to change distribution, right? They already have 100% market share. They want to use this to improve the settlement process in the back office, so to speak. They view this as a way of speeding things up and saving capital. Like that is a major thing that's not distribution. right? When it comes to folks like Superstate, we view this as something that actually goes into capital formation. That doesn't exist today. We haven't really seen examples of this yet, but I think we will soon, which is if you're an issuer, it's a way to actually raise capital differently. A tokenized security can basically settle on the spot. It can settle with stable coins. It's going to create new tools for issuers in capital formation, and we haven't seen that yet. And so I think there's a lot of things that are not just like, oh, it's a tool for distribution. It's a go-to-market for fintechs. Like as of today, right this second, yes, tokenization is a go-to-market for fintechs, mostly like outside the US, but that's a stepping stone.
Robert, I want to ask about the point you made on liquidity, right? So we've been talking about liquidity for tokenized funds and things like that coming online, especially if we got something like regulatory clarity and you had institutions like much more ready to rely on the language in that bill. And then you have a pretty substantial amount of liquidity, but much more volatile in these like synthetics that maybe hyperliquid is kind of like dominating right now. So I guess, do you see where do you see the liquidity coming from in the next few years with like tokenization, and how do you think that's going to play out?
Yeah, it's a great question. I think the market structure that we're going to have is clearly going to evolve a bit, but I think at the end of the day, we're going to hopefully get to a best of both worlds approach where we have this extremely deep liquidity in traditional order books, whether it's the NASDAQ and the New York Stock Exchange. And we're also going to have like the 24/7, global reach of tokenized securities. And they're going to, honestly, like seamlessly integrate with each other. And we're going to get to a world where like, we have strong regulatory controls, we have deep liquidity, but we have programmability, we have 24/7 trading, we have, more reach outside of the existing walls of just the NASDAQ and NYSE. And we have just like a stronger system. There's a lot of things that have to fall into place to get there. There's a lot of companies hard at work. There's a lot of, work being done by the SEC and by, the Hill. But I think that's where we eventually get to.
Mm-hmm. What would you say is the biggest takeaway right now on the front of tokenization? Because it's a very hot market and we talk about it a lot on the show. And I think each guest has their own specific take on the industry, but there's, more or less like cohesion on one side or the other, kind of like to Eleanor's point earlier, like where Superstate stands and Securitized versus like maybe X stocks, Denari, that side of the realm. What are you hearing from institutional players right now, stateside, on what exactly they want from tokenization? And is this as hot of a sector as maybe headlines are making it seem?
Yeah, I think it's a great question, and it really is answered differently by who you ask, right? If you're asking a broker dealer, right, they just say we want more places to trade, and for our customers to be able to trade into, and for us to be able to make fees, right? If you're talking to, the existing exchanges and like settlement incumbents, they say we just want this for the back office. I feel. Pardon?
No, I think that was the producer voice overhead. Don't worry.
Oh, okay. Sorry, everyone. Producer was too loud.
He's like, say that again. No.
Yeah.
I thought that was Gerald being like say it for louder for the people in the back or something.
Yeah. Someone liked what you had to say, Robert. Okay.
Yeah, like they view it as back office, right? When you talk to an individual, like a retail trader, they honestly just want to trade in their pajamas and they want to trade anything. And they like honestly don't care about tokenization and they don't care about how it works. They just want, cheaper, faster, trade from your pajamas. The Superstate view on this stuff is that it's kind of all of the above. And what we want to provide is just really high quality tokens that people can decide where they take them. If it's DeFi and like adding smart contract use cases to it, fantastic. If it's using it for better settlement, fantastic. If it's using it for 24/7 pajama trading, fantastic, right? I think there's a lot of advantages to tokenization, and I honestly think it's too early to guess exactly what the killer next app is going to be. And so we just want something that's neutral, and trustworthy, and credible that anybody can use.
I like the pajama analogy. I've never heard that before.
It's much more polite than like the hedge fund basement manager. Yeah.
Yeah, exactly.
the keyboard warrior.
The keyboard warrior, yes.
Yeah, exactly. Yeah.
Robert, thank you so much for coming on today. We really appreciate your time.
Yeah, thank you for having me.
Thank you, Robert.
Good to see you.
Take care.
You too. Um, the I was going to bring up the Hester tweet before he came on because she did kind of come out and temper expectations around what was going to be in the innovation exemption. I don't
Mhm.
think we're going to see synthetics now based on what she said. Um, she's very cryptic too. I love that she kind of like tells us what's going to happen without actually telling us. She was like, "I've always expected that it would be limited in scope." It's like you wrote it.
Yeah.
Yeah.
I
Well,
always
You know
expected the
exactly
idea
what's
that I
coming.
came up with would
Yeah.
be, yeah.
I also I think like yeah, this isn't new. I think we've actually talked about this on the show before where I've talked to her about this months ago, and it this stance on synthetics has always been pretty consistent. So we'll see kind of like how that plays out. I know, there's so many different ways to abstract away movement of a stock price without actually having it be ownership of a share. And so I think to her point, like if we're actually talking about tokenized securities, we're not necessarily talking about recognizing like exotic swaps or like perpetual futures where one side of the pair is a price of a share and the other side of a pair is just like USDC or something. Um, so yeah, I would say this is probably more like online with what we could expect. But now she's in a new role as well, so we'll have to face this brave new world without a Commissioner Peirce
Right, yeah, let's
doing the
talk about
writing.
that.
Yeah.
I
Yeah,
was
so
surprised by that.
I think a lot of people were more surprised at the fact that she's not going back to her alma mater. I think there was some buzz maybe she was going to go back to Case Western in Ohio, which is where she graduated from, but
That's
she's
right.
going to this very small university in Virginia Beach called Regent University. She's going to go to their law school and be an associate professor there. It didn't exactly say what she was going to be teaching specifically, but it did say she was going to expand the faculty's knowledge in areas like digital assets, securities law, and uh, markets. I believe I gotta pull up my little my tweet here. But she's
Kind of makes me
yeah,
sad.
I know. That's what everyone was saying.
Like a
Everyone's
little
like she's gonna be
sentimental.
a real loss for the SEC. I mean, she's been there 7 years. She
Yeah.
was sworn
Yeah.
in. President Trump nominated her his first term in 2018. Um, financial markets, digital assets, and public policy.
Yeah.
Um,
Yeah.
Maybe it's better beekeeping territory out there. Maybe she'll give it
Yeah,
another
she
run.
did tell
Better
us
better
that's
climate.
what she would do.
Yeah.
yeah,
Yeah.
I was gonna say maybe she's not doing beekeeping full time, but maybe
Yeah.
she'll do it on the side.
Yeah.
It's gonna be interesting to see whether they put up someone to replace her, in this 6 months. I mean, she's got 6 months until November. She's heading there. According to this press release, the university press release, she's going to start in November. So 6 months until she makes that move. But we haven't seen President Trump nominate anyone to the CFTC or the SEC, any of the financial regulators, since he took office. So it may
Mhm.
be just Paul Atkins and Mark Ueda, or he may nominate someone to replace her. I think there are a couple names in the running who who might uh, who might have a shot. We'll have to see, but she's a Republican seat, so we haven't seen any Democrats nominated, but also haven't seen any Republicans. But
Yeah. And I will say, because this came up on the CFTC side too, right? Like I think just given how people think the fall is going to go, like if you did want to get confirmations through, maybe better to do it sooner than later. If you were thinking about like political winds shifting in DC at all. So yeah, we'll see how the administration handles that. But it would be great to see some full commissions. That'd be nice. So we'll
yes,
see.
for sure. Um, and let me just see here. She
You wanna
is.
talk payments? Or we're
We could talk about payments.
I mean, listen, I'm just reading the headlines
Yeah.
on the screen.
We
But
are doing it live today, guys. We are doing it live. Yes, we should talk about the payments because this was pretty big news this week. Trump signing 2 executive orders aimed at cutting barriers for fintech and crypto firms, and he also directed the Fed to explore expanded access to payment accounts and services for fintechs and crypto firms. It also was kind of an interesting coincidence because the Fed also proposed the next step in rulemaking for its payment accounts, aka the skinny master accounts, which we broke the news about a couple months back
Yeah.
with Fed Governor Waller. And that's basically the next step in implementing those. I think the goal is to get those rolled out by the end of the year still. They're still working towards that timeline. But the goal is to have crypto companies get access to the Fed's payment rails for settlement and clearing purposes. And there's a couple of edits that they've made to the payment accounts since we saw the proposal in December or February. Can't remember which one it was, but yeah, there's been some updates there.
Yeah, I personally was curious about how different this
Yeah.
is, like on the executive order side versus what the Fed was already kind of trying to roll out. Do you have any like insights on that? Because it seemed like the skinny master account thing was kind of already doing this, but I'm not sure like what the additional benefit was. I know we can talk to some of our guests about this today, but yeah, it's an interesting kind of like, is this actually new, or like what are we actually rolling out here on the EO side, that the Fed like wasn't already doing?
I think it's just a broader interpretation of like what the Fed could be able to do, but the Fed also has to like the EO, Congress still has to be able to like tell the Fed what it can do.
Right.
So I think it's kind of just like,
Mhm.
I don't know if it's like a moot point, but we could ask Caitlin Long about it. Caitlin Long is she's here and she's ready to go. Let's bring her in. Caitlin, welcome back to the show.
Hey, good to see you all again.
How are
Hey,
you?
you too.
Doing okay, thanks. How are you?
Good, good.
We're
We were just
good. Happy Memorial Day
yeah.
weekend.
We were just talking about the implementation of the Fed master accounts, which we know you've been hot on the topic of for quite a long time. We're talking about the EO as well because we saw President Trump implement that this week. What's the difference between him implementing this EO and then kind of what the Fed is doing around the payment accounts?
I mean, there's nothing new in the Fed's payment account. I just heard you asking, is there anything new? There's literally nothing new. The Fed has maintained that it can do whatever it wants for any reason. And if you look at what the payment account proposal says, there is literally not a single commitment. In fact, they actually explicitly say there are no commitments in this proposal. And while they go to great lengths to try to distinguish master accounts from payment accounts, they also say that in their view, they've had the ability to put whatever restrictions on master accounts all along to create de facto payment accounts. By the way, as you've interviewed me before, I'll reiterate, Custodia proposed what is functionally a payment account to the Fed in March 2022. So this is not new, and there's nothing new about it. The executive order is new, and what's interesting is that the executive order requests the Fed. So there's no actual directive, but there's something very interesting in the executive order, which multiple people contacted me about to say, did you write this? And no, I didn't, but it's fascinating because it asks the Fed to justify Federal Reserve Bank presidents making decisions. That is a tell because under the appointments clause of the Constitution, officers of the United States have to be either directly appointed and fireable by the US president or by a Senate confirmed officer who has been appointed by the president and Senate confirmed. Federal Reserve Bank presidents are private citizens. They cannot be fired by the US president or by a Senate confirmed official. And they are doing official acts. And the White House actually asked the Fed to justify whether that's legal. That is quite a tell because it's pretty clear the White House doesn't think that's legal.
Mhm. Yeah, and there was more action around sort of, what could come out around, Operation Choke Point 2.0, And what happened under the Biden administration this week, Caitlin, with the SEC's gag rule was rescinded this week. It's a policy that for decades prevented companies that settled with the regulator from publicly disputing and criticizing pretty much the allegations after the fact. And, you've had some thoughts on this. It could be, now people who have settled with the Fed in the past, victims of these, these settlements, these lawsuits, especially in the crypto space, could come out and talk more about their experiences. I mean, do you expect former executives, former companies to come and start speaking publicly more about their experiences that they had under the prior administration?
Yes, it's already happened. The chief operating officer of Silvergate appeared on Twitter in a brand new Twitter account and started talking. And that was fascinating. And she pointed to the fact that the SEC changed its policy on the no denied, no criticism requirements and voided that phrase. So she is now able to talk about the SEC. The Silvergate executives have been muzzled. They've not been able to talk. But a lot of people who were aware of what happened to Silvergate have been able to talk. And what's new, we've known for a long time that Silvergate was, to use one Twitter observer's word, assassinated. And it did not actually, when it failed, it didn't actually fail, to be honest. It just unwound and paid off all depositors. There was no loss to the deposit insurance fund as there was with Signature, Silicon Valley Bank, and First Republic Bank, the other banks that failed at that time. And all the uninsured depositors were bailed out from those banks. But 10 banks have failed in the Heartland since then, and none of the uninsured depositors in those Heartland banks have been bailed out. That's the kind of thing that makes the average American seethe, that these so-called oligarchs get bailed out and regular folks do not. But I digress. The Silvergate situation is Exhibit A, that things happen sometimes behind the scenes, and that handing unelected, unappointed, unconfirmed bureaucrats who cannot be fired by the US president unlimited power to do whatever they want for any reason and not have it judicially reviewable, that's a scary thing. And banks are starting to wake up to that. The Silvergate story has been out there for a while, but some of the bank analysts and bank trade media are picking it up. Max Field on Banks did a really interesting analysis because he's right. He pointed out that Silvergate is the first bank in US history that was a fractionally reserved bank that unwound but survived its bank run and did not stiff its depositors with any losses. And he was fascinated that there's some lessons for traditional bankers in that situation. And he's absolutely right. So I think the fact that the Silvergate executives can now speak, you're going to see them giving interviews, and I encourage it and will listen to every one of them.
Yeah, Caitlin, I want to ask you about a point you made a moment ago, just on sort of seeing like something being very telling, or seeing sort of the writing on the wall, and just how we see the Fed evolving over time. So I'm gonna use a ridiculous sports analogy, and you guys will stick with me for a second. But the NCAA was kind of this like infallible institution in college sports for a long time, right? And they had the ability to kind of control their own destiny. They made a bunch of mistakes around like paying players or conference games or whatever. And the conferences kind of grew to a level of strength that really kind of forced the NCAA's hand in a lot of ways, and their power like to sort of oversee the system that was self-governing has like deteriorated. The Fed has been such an underpinning institution of the stability of the global economy, for decades and decades. Do you think some of the mistakes that maybe they've made, or maybe some of this questioning of transparency, could actually change like how the Fed behaves or is forced to behave in the future? Like how do you see this going and playing out?
Well, we're taping this right as Kevin Warsh is being sworn in as the
Right.
new
I know
Fed
we're gonna
chair.
talk about that. Yeah.
Exactly. And he has committed to regime change. One of the challenges, and I'm certain that he's aware of this, is that the staff at the Fed doesn't want regime change. So, I mean, when you've got people who have in senior staff positions who've been there 35 or 40 years, you know, their incentive is not to change. And vis-a-vis crypto, they're all prevented from owning crypto assets. So most of them probably have never interacted with a public blockchain. That's not true for Kevin Warsh. But the interesting question is, how effective is his regime change going to be able to be, given staff is not likely to be supportive of it? Well, I know in most cases that they don't support it, especially vis-a-vis crypto, but also his board, he's walking into a board where he's one of 3 Republicans. There are 3 Democratic appointees, and then Jay Powell stayed on, and he's nominally a Republican, but he's a never Trumper, right? So Warsh has got a board that's 3-4 against him. And he's got the power of the chair, no doubt. He can set the agenda, but it's going to be very interesting. One of the first things I'm looking for is by tradition, the FOMC has voted the Fed chair in as chairman of the FOMC, but it's not by law or requirement. And if you look at who the voting members of the FOMC are today, they're not, not majority Republicans. And so if he walks in, as he's doing as a Trump appointee, having been sworn at the White House, a lot of people commented on that it might have, they were sort of questioning whether being sworn in at the White House versus at the Fed itself was sending a signal about his alignment with the administration. And I don't know if that's true or not. It's just people were commenting and asking. But how much power is he going to be able to effectuate? And the first question that we will get an answer on fairly soon in the next, I would guess, couple of weeks before the next FOMC meeting is Jay Powell actually still going to be chairman of the FOMC, or will the FOMC vote the new chair in, which they've always done by tradition, but it's not required. And I would point out that it's always been the tradition for Fed chairmen to step down from the Board of Governors. Jay Powell did not do that. He pointed to the fact that it wasn't the first time in history that there was a prior Fed chairman who stayed on the Board of Governors after he was chairman. But he was asked by the president to do that because they were working on something specific. In this case, Powell and the president are at odds with each other. So Powell did break tradition. And I wish Kevin Warsh well. He's got a difficult job, and it's going to be fascinating. That's the first hurdle that I'm going to be looking for. Did the FOMC appoint him to be chairman of the FOMC, or did they keep Jay Powell on as chairman of the FOMC?
Can I ask a super quick follow-up on that? Because you
Sure.
made a really good point on the job that he is inheriting, the environment that he's stepping into today versus the one that was, going to be easing and was kind of on the table when he was initially nominated, are very different. Like, how do you think he's going to have to navigate the kind of original agenda versus like the present conditions that we see with everything going on globally? It seems like a very tough job.
Yeah, historically, the Fed used to have more dissent than it has had in the post-Greenspan era. Greenspan was the first of the sort of super Fed chairs. And then Bernanke and Yellen and Powell followed in that footstep, where they generally tried to get a consensus and generally had 7-0 votes at the Board of Governors. And the way the FOMC works is it's the 7 Senate-appointed boards of 7 Senate-appointed governors, plus a rotating 4 Federal Reserve Bank presidents, one of whom is permanent, the New York Fed president. Remember what I said earlier, those Federal Reserve Bank presidents, those are private entities legally, and the presidents of those are appointed by the boards that are controlled by the banking industry. Those are private citizens that the US president cannot fire, and that Senate confirmed Fed governors cannot fire, right? So the rotating of those 4 are there, right? So back to your point, if they are on board with the president's agenda, then you would tend to see that there won't be dissents. But what we have seen is a fracturing of the votes. We've seen the highest number of dissents and the most partisanship of both the Board of Governors votes and the FOMC votes in the Fed's history in the last several months. And so the real question that we'll all soon get answered is the partisanship going to calm down, or is it going to even potentially get worse on the Fed? And we will see the answer to that. If I could come back to the master account question, Ellie, one thing I did in preparing for this today was go back to your interview with Governor Waller back in October. He said something really interesting that I caught at the time, very few people probably did, which is that he asked if the Fed's own systems were capable of doing real-time monitoring of master accounts. And he said he didn't want the Fed to take 2 to 3 years to upgrade the system. He was hoping to get it done in 1. I'm paraphrasing, but the transcript is easy to find. And what's fascinating about it is I think that's quite a tell, because I've been watching the modern banks that have been either getting tier 1 master accounts because they're FDIC insured, like Erebor, for example. Hat tip to Jason Mikula, who discovered something interesting, which is that Erebor wasn't using their master account for certain payments. They're using a correspondent bank for certain payments. And I think what's really going on is the Fed hasn't yet upgraded its own systems to be able to handle real-time payments and real-time monitoring of Fed master accounts. And Waller referred also to ensuring that if someone kept money overnight in a payment account, how would the Fed ensure that they weren't lending it out in the Fed funds market overnight? Those kinds of things, he was saying, were not in place in the Fed's own systems yet. And he gave you that interview in October and said he'd hoped to be able to get it done in 1 year. And with the new proposal, note that they're giving themselves through the end of this year before they start turning on accounts. I think the whole idea is that even though the Fed loves to blast innovators and retaliate against some of us for daring to try to innovate, the real truth is right there in that tell, that it's a question whether the Fed itself has the tools to engage in real-time markets outside of FedNow. Definitely in FedNow, yes. But outside of FedNow, sounds like there are some system upgrades that have to be completed. And he was hoping to get it done within a year of October. They've given themselves through the end of this year with the announcement that came out this week. So just putting some puzzle pieces together for folks. And I think anybody who was optimistic that they'd be able to either get or use a master account for real-time payments, it's not going to happen anytime soon for anybody, including those that nominally have master accounts. They're not being used for real-time payments.
Mm-hmm. So then for crypto and fintech firms actually trying to access the Fed's payment rails, with Governor Christopher Waller's skinny master account proposal in mind, does this actually solve the problem, or no, it's still a long road ahead?
It's a very, very long road ahead. Remember the staff. I wish I could give a hat tip to the person who put out a tweet thread about it, where he used to work at the Fed and now he's in the crypto industry. And he said, you've got to understand just the incredible immune response of the staff at the Fed to any of this innovation. And I think for those of us who've been working on it for years, we've lived that. And he was basically saying, it's not going to change. And so again, coming back full circle to what is Chairman Warsh going to be able to effectuate? No one knows. He certainly has committed to reform, and hats off to him in that regard for sure. But we've got to watch. And I think the biggest conclusion that I drew from the announcements of this week, with the executive order requesting the Fed to start letting fintechs in, and the Fed releasing these new rules that commit it to literally nothing, is that nothing has changed, and the banks can rest easy that they will not have fintech competitors being able to use master accounts for quite some time, if ever. I would refer back to OCC Comptroller Gould's recent speech where he talked about this, that the Fed just never constrains itself, never commits itself to doing anything. And that he even commented that the Fed did certain things in response to the lawsuits that had been that it was in litigation with, and those have never worked. So so stay tuned. One of the things he was referring to was the payment account, or was a master account access guidelines that got created in 2022 with lots of fanfare and lots of expectations back then for innovative companies to finally be able to get in and get direct access to the payment rails. A grand total of one company got a master account under those guidelines, and it was a Fed-connected company. It was a bank started by former Fed Vice Chair for Supervision, Randy Quarles, as an organizer after he left the Fed. So
was it Numisma Bank, Caitlin? I remember writing
correct.
about it.
You've written about it, exactly. It was the only one under those guidelines that ever got an account. And back then, I think I can share that the Fed was telling Wyoming officials that just wait till these rules get put in place. The Wyoming Speedy Banks will be waved through. And of course, that didn't happen. So be careful getting expectations built up too high.
Caitlin, thank you as always.
Yes,
Thank you. Good to see you all.
Thank you.
We'll be in touch.
Sounds
Cheers.
good. See you soon.
All right. So joining us now to wrap up the show is Simon Babakhani, CEO of Zebec Network, one of the original pioneers of PayFi, real-time programmable on-chain payments. 5 years in, Zebec has grown into a multi-chain payments network spanning Solana and now XRP Ledger, which we talked about a little bit in Vegas, with a consumer card, a token, and a mission to crack open the $11 trillion global payroll market. I recently sat down with him, as I mentioned, at XRP Vegas, and we're excited to have Simon back on. Simon, welcome to the show.
Hey, Joe. Great to see you again.
Good to see you too. So Simon, break it down for us. What exactly is PayFi, and how is it different from like DeFi or normal stablecoin payments?
Well, PayFi is all about upgrading the existing payment system to the blockchain standard, and that's what we've been working on for the past 5 years at Zebec. You can think of us as the rails that allow enterprises to pay their global workforces or contractors in stablecoins. We've always been a stablecoin native solution because we believe that stablecoins are faster, cheaper, and more efficient than anything else out there. And we plug into the banking system through our MasterCard products and our on and off ramps. We operate as a white label platform. So whether you're an ecosystem, you're an enterprise, you can have a fully branded experience, but Zebec powers the payments behind the scenes.
Mm-hmm. Can you kind of explain to us what is programmable on-chain payments, building off of like the PayFi side? Because I feel like a lot of times we use the word programmable, and I was talking to someone outside of this industry recently, and they're like, "Why would you ever put that in a headline? I have no idea what that means." And I was like, "Oh, right. Like it exists within our world, but not maybe as talked about outside of it."
It's a great question because there's a lot of companies out there that say they do stablecoin payroll, but what they really do is they do regular payroll, but they let you convert some of it into stablecoins on a bi-weekly or monthly basis. Zebec is completely different because we are blockchain native. We built everything through smart contracts that exist on chain, and that's where the programmable piece comes in. So through this smart contract logic, you can program pay to be dispersed in any increment of time. Whether it's by the hour, by the minute, or even by the second. Of course, depending on the blockchain, the fees can be very little to meaningful. So that all is factored into how you program pay for your workforce.
Mm-hmm. How different would you say Zebec is from other competitors in this space then?
Well, we're the only ones that are A, blockchain native, B, run on smart contracts, and C, support multi-chains, right? We were born in Solana, as Gerald rightly said, and this year we've expanded into the Stellar blockchain. When I was at XRP Vegas on stage with Gerald, we announced that we are now partnering with Ripple, and we'll be expanding to the XRPL, and we have many more on the horizon. So we don't want the enterprises to be really fussed about what blockchain they're using, right? For them, it's about having a seamless, usable payroll experience, and then Zebec routes payments on whatever chain is most appropriate.
5 years in, Simon, how do you see employers moving to per second pay, or is that still a crypto native use case?
A great question. I mean, the first 3-4 years, I'd say, was very slow growth for us on adoption. And then when the Genius Act passed last year, it really opened the floodgates, and we saw more and more enterprises reaching out to us, asking how to implement stablecoins into their flow. And now with the Clarity Act coming, we expect the next surge hopefully to hit as more and more enterprises have trust in the stablecoin system. Now, many of our employers are using us as an option alongside fiat payroll. I'd say that's kind of the most common. And then we have some that are fully operating on a decentralized payroll model with Zebec.
Mhm. When you say enterprise businesses, how would you kind of define that? And are you seeing it being traditional Web 2 enterprise businesses in a specific area, or is it really across the board?
So we have quite a diverse group of clients at Zebec. So initially, we started with Web3 companies, given that they were already holding their treasury in stablecoins. From there, we acquired a number of payroll companies in the US that would work with primarily SMBs, so companies with like 50 to 250 employees. And that was really the next segment that we focused on. And now, with more trust in the system and the stablecoin regulation passing, we are now able to work with what I call the larger enterprises. And these are companies with over 500 employees. We'll have a few of them coming online in the next few months, and we'll be making some marketing announcements around that. But for them, typically the use case has been on contractors and international payments because that was already a sticking point and had a little bit more cost than the domestic payments for them.
And Simon, without getting too deep into the weeds here, tell us like how does a native token like help this system function? What's the use case there?
Yeah, so our native token is called ZBCN. It is an ecosystem token. It is required to use our products. So whether you're using our retail super app, which is a way to really manage your payroll streams as a retail user and load cards, you need Zebec tokens to do that. And then all of the fees in our payroll system, which are, by the way, a fraction of what traditional payroll companies charge, because most of them operate on a per employee basis per month. All of those transaction fees are paid in ZBCN token, right? So that's how we really keep the token as the beating heart of all of our products.
And I think the CPCN token is governance and utility, right,
Correct.
Simon? So can you kind of walk us through how the token actually works?
Exactly. So on the governance side, we have a voting mechanism for general improvements to the Zebec ecosystem, which we've done now over the past couple of years, including our migration from our original token to the new Zebec network token, which really represented our upgrade from being a protocol on Solana to a multi-chain network that we are today. The utility side of the token is really, it comes down to the product usage, as well as our staking rewards and then paying fees in the token. So as we move forward as a project, we will have more and more use for the token. But at the end of the day, really that is our North Star as a company.
Mm. Now that we are in this post-Genius world, it's been almost a year now. Does the stablecoin regime, so to speak, actually help your company, or do you kind of view that shift in regulatory policy as no, actually, I wouldn't say that. I was going to say as like a deterrent, but absolutely not. No, it's a helpful accelerant, right? Like a tailwind, maybe.
Overwhelmingly positive. I mean, when you
Yeah.
look at our history, there was years where we couldn't even have a bank account, right? We're a U.S. company, and as you remember, in the Biden era, it was very hard to even get a bank account as a crypto company, let alone launching a debit card product. So we've come a long way from there. There still is a lot of friction, though, with some of these larger enterprises that are toying with the idea of implementing stablecoins into their flow, but they don't want to take any risk, right? I mean, payroll is just something you cannot afford to mess up, and a lot of HR teams, the mentality is let's not change it unless it's broken. And we are now doing our best to run an education program across America as to why employees and contractors would actually benefit from stablecoin payroll, right? Getting paid faster, reducing their bank fees, being able to move money abroad seamlessly and connected to a MasterCard are all really strong selling points. And then if you see the demand and the interest coming from the actual employees of the company, it's more likely that HR teams are going to listen.
Yeah, Simon, I mentioned at the top of the segment that it's payroll's an $11 trillion marketplace. You guys obviously want to chip away at that and get some of that market share. But specifically, like 12 months from now, and I know you guys have also been around for 5 years, so pretty mature in the space. What is the kind of single metric for you that you're going to be looking at that says PayFi in the space are here to stay and have been successful?
I mean, if you look at the month-over-month growth in stablecoin volume, I mean, that's already a huge vote of confidence that, PayFi is gaining traction. For us as a payroll provider, what we look at is the number of enterprises out there that are currently piloting or using some sort of stablecoin payroll, and then how their share of wallet increases, right? So Maybe a pilot program will include 5% of employees or 5% of total payroll volume. How does that change after we implement education and marketing initiatives in the company over time? And if you look back at most of our clients, many of them started with a very small pilot program, and the stablecoin piece continued to grow and grow. So those are the sort of things that we track at Zebec.
Amazing. Well, Simon, thank you for coming on today, and keep us posted on the next 5 years. And
Thank
we'll
you for
probably have
having
you
me,
back
guys.
before, but
Thank you. When you come back, we're gonna have to talk about that art collection behind you. I love that. That's pretty good.
Definitely.
Cool. Thank you
Awesome.
so
Thanks,
much, Simon.
Thank you, guys.
All
All
right.
right.
All right, guys.
Memorial Day weekend, right?
I promise we're
made it.
not checked out. Okay. We're going to be checked out after this, but this was good. I think there's so much going on right now. And actually, for our listeners, I don't know if they noticed it, but we did the first guest as a part of the headline. So if you like that structure, let us know, because I actually think it could be a fun way to run the show. So.
Yeah, we'll have
Yep.
to jam on that one.
Okay, maybe not. Okay.
Yeah.
But yeah, thanks guys, and thank you to everyone for listening in.
All right, guys. See you next week.
See ya.
All right.